Hey guys, Freaky Finance here. This week we're going to do Target. So we started Campbell's video a week or two ago, basically talking about more defense as things keep hitting all-time highs again. So this video is on that theme, and we're going to go into some things I really like about Target and the space that it operates in general, which is far superior to my mind than the national brands that are out there that you can buy that are also cheap, but not as cheap as Target is, even though Target probably has a superior business model to them. That includes Pepsi and Coke. I do believe Target has a superior business model to all the consumer staple brands out there. Most people, it's always nice to do a video, most people know the store. So most of the viewers will be familiar with Target and kind of what it represents. One of the reasons why we're doing the video is obviously the share price has been depressed. So it's a good time to do the video. I'm actually glad it's down. Usually when I select the video I'm going to do, usually by Tuesday of the week, for whatever reason it keeps rallying by like Thursday and Friday, and I haven't even like finished my work, and it's just like, oh, well, I have to do a video right into a increase. So let's see here. I do own this one, so I should disclose that. I have started not a full-size position yet, but it's pretty close. So, and I've been averaging in slowly over time as the thing sells off 1% or 2% a day, relatively steadily. I've just been slowly buying. So it's kind of how I do things. I just kind of toe in. Same thing with PayPal, just kind of toe in again. And these are more value, in my mind, more defensive plays. And we're just rotating from the outperformance, right? Like I said, we're up 50% on the year. The market's up 13. It's usually a good time to just start positioning yourself defensively again into things. And value is not technically a defense mechanism, but it allows you to more easily buy things as they get sold off. If something's at 8 times earnings, it can buy 10% of itself a year. That's nice, right? It's a nice thing to have, a peace of mind when you're going into a company or averaging into a company. So anyway, one of the reasons why the share price is under pressure is because the business has been stagnant for 3 years, actually 4 years now, which is unusual for Target. It's usually a slow grower over time. There's a reason why it's in the consumer defensives category. One of the great things with Target, and this is a great thing with Kohl's too, is that they own a lot of the properties because they've been around for so long. A lot of these things, the land, $6 billion in land is at historical cost, right? So you know it's worth more than that now. You have a lot of stores that have depreciated down quite a bit over time, so you know the building value is actually higher than what they're reporting on their books. So there's a lot of value here, and they actually own, you can see here, they own, of the almost 2,000 stores, they own 1,500, right? And then they own another 160 of the buildings on leased land. So that's pretty special, right? And then they also own a lot of supply chain as well. So they own a lot of the underlying assets, which is nice. It's one of the reasons why their margins have been okay. They haven't been squeezed by a landlord because they own the land, right? There's not like a lease, like a REIT that they have to pay, right? So this is, it enables them basically to be more resilient when times are tough. And it also gives technically a value backstop if we were to go that way, which the AI did. Maybe I'll share that right now. So basically what I did was ask AI to come up with what it thinks the value of Target's properties are based on that 10K that I showed you from 2024. And anyway, I basically said, this is what I think each one's worth in terms of their PPE. So this is what they reported on their 10K, 33 billion. This is what they think that the historical cost was, 57 billion, basically adding back the depreciation that they've taken. So, and you can see how it splits out a lot of the PPE is buildings and improvement. You can see 6.5 billion still there, which is nice. And then it tries to basically say, oh, this is how many buildings you own. So here's the 1,700 retail stores is the estimated owned square footage, so it estimates that. And then it tries to say estimate a value per square foot. And so it's kind of interesting. So basically it comes up with 39 billion, 50 billion, and 62 billion in terms of the actual value of the underlying properties, which is special. Then it says, well, the market cap's only 40 billion, so technically Target trades less than the expected market value of its current properties that it owns, which is interesting because technically the AI right here leads to a stunning conclusion. The real estate assets alone were sold at their estimated market value. The proceeds could theoretically be used to buy back every single share at Target and leave it $11 billion left over. So basically the market's saying Target is, even though it makes $7 to $9 in earnings this year, it's guiding to anyway, it's basically saying it's worthless. The revenue stream and the income stream, which is exciting, right? So that's a nice thing to also have, and it makes it easier for me to buy as Target sells off, right? And then you have the AI was like, how can I realize this value? And it kept going. So it was like, okay, we could do a sales leaseback, which I'm not a fan of, but it can add value. You can do a REIT spinoff, which is something Canadian Tire did. There are ways to get value, especially if there are specific pieces of land that have appreciated a lot and you can buy back your shares when they're at 10 times earnings. It could be accretive, right? But you need to be careful, because not having a landlord raising rents on you each and every year helps these guys a lot in terms of managing inflationary costs over time. So there's a trade-off there. That's what I'm trying to articulate. All right, so back to Target. Again, over the last 3 years, I'd say relatively flat in terms of operating income. I mean, slightly down. So you basically have a lack of growth. They did some good work with the cost of sales to offset it, but you can see inflation on the SG&A expenses still, and that's without, I mean, they own a lot of their stores, so a lot of that's labor. So you can see they're still seeing inflation on the SG&A line, even though revenue stagnated, and that's basically leading to a little bit of a squeeze in terms of the operating income margin, right? You have gross margin rate. They've been able to take it up, but SG&A expense rate has gone up slightly over time. We'll go through a 5-year history in a second. I made the AI just pull the model for the last 5 years. But anyway, there's a couple interesting things here on the trend. And this is important too to understand. Target sells a lot of different things. And there's certain things that are more defensive and things that I like more. So I like beauty and food and beverage essentials. So these things in my mind are stickier. So when people are selling down, they're not likely to cut whatever you need to maintain a home or clean a home, right? Or what obviously to eat. They're not going to cut that down as readily as they will cut hard lines, say for example. So that's like electronics, like your Nintendo Switch kind of thing, right? Which did well at Target actually this year. But you also have apparel and accessories, so you might really cut back. Maybe you buy Amazon Essentials kind of thing if you're me. But I'm just trying to say that there's different segments within Target that are more resilient to consumer discretionary pressure. And there's other ones that are more directly impacted, especially you can see here, Target's actually done a weak job in my mind in terms of home furnishings. Now, home furnishings has been under pressure for 3 years, right? There are reasons why a lot of these big retailers, like Big Lots, we did a video on that one, that really highly levered company, was having a hell of a time trying to sell home furnishing stuff, right? And you're seeing this here at Target as well, right? Basically, one of the reasons why merchandising sales is down so much, right, is largely just because of home furnishings, right? A lot of the rest were able to tread water, or relatively tread water. They are doing something here that I do like, that they need to continue, is advertising. It is higher margin, so the more revenue they can get per dollar, advertising revenue will help their margins. Their gross margins go up over time. But again, that can be offset by whatever the sales mix is at a given quarter. You're going to see this advertised revenue, I think, accelerate. And there's a couple of reasons why I think that, but that's just, we'll go into that in a second. And this slide was really good. I think it was kind of like their little investor day they did. But anyway, you can kind of see what I was saying here. You can see home is highly impacted by the cycle, but beauty, food, and essentials are low, right? You're more likely to cut back on buying the new lamp or buying the new shirt than you would on food and beverage and essentials, like cleaning supplies and paper towel and toilet paper, right? And then you can kind of see that they're snapshotting here really the last time they grew. So in this slide, they're kind of misrepresenting the last 3 years, right? They're basically saying they still grow. They did grow from 2019, but they haven't grown since 2022, right? So that is something they're also trying to angle. They did replace the CEO finally after 3 years of stagnation, which is another change, which is another reason maybe why we're getting a deal, because people are like, oh, change the CEO, change the strategy. Let's sell and see what he does. Right. One of the great things with Target, though, in the longer run, like if you go back to 2009, you can see it's gone from $64 billion to $106 billion. It's gone from being stuck around $3 to $4 in earnings power to slowly going to $5, marching to $6. Then it over-earned in 2022 to 14, but you can see it's gone 9, 6, 9, 8, right? So it has improved over the long run. And so far we haven't really seen it. We've seen it stagnate, but we haven't seen a material decline. And a lot of them are guiding to 20% declines already, right? Like most estimates are expecting Target to put 7.5 this year, right? It's not like it's asking for a lot. A lot of it's down 20%, right? The earnings power, the stock's down like 50, right? This thing used to be at $200 a share, and now it's at 80. So it's just worth pointing out another thing they've been doing with the cash flow. Instead of, they do pay a good dividend as well, but they've also been buying back a lot of shares. So you can see here, gone from, if you go all the way back, 775 million. Now we're down to 450 or so, 455. So material decline in shares outstanding, which is nice as well, especially comparing it to just say to 2018. You basically bought back 20% of the company, right? And people are anchoring on that price because that's the price that it's currently back at. It's back to 2018 levels, even though the market, or even though Target only did $72 billion that year, right? Now it's at 106, right? Back then it was only putting up $5 in earnings power, right? Now it's still guiding to 7 and 9, right? So there's some interesting dynamics here, and the reason why I'm doing the video is basically because of this. It's just a decent business model that's getting slapped hard because it's no longer growing. So you're seeing that earnings compress. Basically, the market's saying we don't think you're going to grow ever again. And I just don't think that's true. And I'm getting decent odds at this price because, I mean, the last time it was here, was, like I said, 2018. So I'm getting a decent entry on a position that has actually done relatively well versus 2018, right? And then in the context of other businesses like General Mills, which has a 12 to 13 times earnings multiple, you can see this business is largely a lot more stagnant, right? It's very defensive, 17 billion, 15 billion, 16 billion, 20 billion, 19 billion, right? But again, flatline for the last 4 years. And you've seen slow appreciation earnings power from like 3 to 4, right? So, and this was a higher multiple than Target, right? And it's growing lower than Target has in the past. And far more importantly, we're going to talk about some reasons why I really like the end retailer more than the people who put products on the shelves for the end retailer. There's a lot of strengths that the end seller has, the end retailer has. And these strengths, I think, will only accelerate in the AI world. Here's another one. Macy's is, again, more stagnancy, higher multiple than Target, with less growth. So this is kind of things I look for. I'm like, okay, why would I buy this stock when I can buy this stock and have the same defensive properties, if not, and a better business model at a better price, all at once? So that's what I kind of juggle with. And Target, just so we can, let's just do the forward P. You can kind of see how it trades. So you have 34 times Walmart, 47 times Costco, Target, 11 times forward. And this is around the price that we were able to get Dollar General, and we were able to flip it for more than 50% gain in a very short amount of time, right? So I'm treating it similar to that setup, though it's not as obvious to me. I mean, there's some de minimis exemption benefit there for Dollar General, but it was just, in my mind, I'm kind of at that point. I'm like, okay, I can buy 11 times this, or I can buy 11 times or 12 times Kroger's, and I'm like, I mean, Kroger's pretty defensive too, which could be a good video. Like I started a position in Albertsons, but I'm seeing a lot of these consumer staples are still at Target's price or lower, right? Or higher, rather. Like, so it's like, And so the Campbell video to this video is very interesting, right? So Campbell's technically 30% more expensive than Target, even though Campbell is also decreasing their earnings 20% year over year and has a lot more pressure on their inflationary line, and Target will be more able, in my mind, to handle it. There's not a lot of people that own Target. It's not like there's some activists. I was looking at the top holders, and no one really has conviction in it. Like some people have, like their 6th highest position, 4th highest position, right? One guy has it at 2, but it's only 3% of his portfolio. So there's not a lot of people that have overexposure to Target, which is also nice. So it means no one's looking at it, in my mind. So not always true, but in this case, I think it is. So let's go through the information really quick. I've kind of rambled already, but you can see the stagnancy over the last bit, but since 2020, it's growing well. Net income is relatively steady and stagnant, I'd say, 4 billion. The good thing, like we talked about, the fully diluted share count's been going down. The great thing is that the share price has crashed, which is great, right? So instead of $78 billion valuation for Target 5 years ago, we're able to buy it now at $40 billion. A lot nicer. And that's including what the AI thinks is $53 billion in real assets in fair market value terms for the properties it owns, right? Which is nice. Indebtedness did shoot up. They actually took on debt and bought back shares, which is a problem we saw for other companies in 2022, basically to try to juice the EPS growth over time. And that usually backfires when your PE is high, like it was. I mean, it wasn't crazy high. I think it was like 15 or 16 times when they were buying it. But you can see they would much rather buy their shares at $88 than they would at between 135 and 200, right? Here you can see the CFO, again, relatively strong, I'd say, against the CapEx. They do put a decent amount back in the business, and they probably chased a bit in 2022. But you can see here, free cash flow is relatively strong. They cover the dividend historically very well. And then you have share buybacks, which shot up in 22, and it's kind of been gradual. They actually stopped it in 24, but it started up again, at least according to the AI. Revenue growth, you can see how it kind of flatlined here and slowed down, so that's why we're getting multiple compression. Target's been basically trying to push its SGA inflation through its margin line, and it has been relatively successful, kind of like treading water, I'd say. Here you can see the GAAP EPS hold up relatively steady. Again, we're guiding 7 to 9 for this year. They are, and you can see the PE ratio. If they were to hit their current or what they did last year at EPS, which would be too good to be true probably at this point, I would give it a 10. So it's probably around 11 if they put up like 7.7 or something, or 8. Anyway, and you can see here inventory turns finally starting to improve again, but it's not as good as it was. So that tells me that the inventory hasn't been dealt with but at the end of 2024. Now we're going to go through some comments that say they think they're through most of the tariff inventory impact for the back half of 25, but the analysts don't know that, and I don't know if management even knows that, but they did communicate that. Some of the great things that I like about Target is the private label penetration. So most of the big retailers already have a large percent of sales running through their own private label. And that's important. So what I mean by private label, so Walmart, Great Value, Equate on the health side. Target, you have Good and Gather, Cat and Jack, Up and Dealworthy, Costco, Kirkland, obviously, Kroger, Private Selection, Simple Truth. A lot of you go to a grocery store, you're going to see a private label. And these are taking share over time. So now it's about 33% of sales at Target, so $30 billion. Not small anymore. Walmart also big, huge, $200 billion in private label sales. The margin, and this is what's critical, one of the things, is that the margin on these sales are a lot better for the retailer. So if they sell you a great value product, they make more money than they would if they sold you one of the national brands, like a Campbell's soup, if they bought the great value soup, if there is one, right? That actually helps Walmart more. So they make about 9% more money. So instead of, they're basically here, the AI thinks national brands, the retailer make about 26% margin, private label brands, the retailer makes about 35% margin. Then I asked it why, and it said, well, it cuts out the middleman. Fair enough. And then it said, well, you also get reduced marketing advertising versus national brands. You don't usually see a Walmart great value brand advertising versus like a Pepsi or a Lay's or Doritos, right? They usually don't need to push it the same way because they can really just place things on the shelf where they want to and advertise when you're in the store. And then pricing, they can find gaps because they have the end user data, and we'll talk about the data in a second. They could basically find gaps in the offering. Like, okay, this person likes this and this. They would likely buy this as well if it was offered at this price. And then they're going to be like, okay, how can I make this product at this price? And that's something the national brands that just have to basically sell to the big retailers can't do. And there's also the Michael Porter's 5 forces on this, where basically a lot of the power is in the big retailers. It's in Walmart and Target and Costco. They have the power. And these one of the reasons why these staples are all buying each other is because they're trying to get bigger in size, so they have some strong power still, right? So they have that brand, like, no, you can't boss me around because you want Coke in my stores, right? People might go to a different retailer if you didn't offer Coke in your store. So that's what's kind of happening now. It's kind of like a little bit of an arms race. And I think the retailers at the end of the day will continue to win just as they have for the last 10 years. Here's a trend over time in private label. The AI couldn't figure out Walmart's, but it could figure out Target's. So Target's went from about 15% of private label penetration to now 33%. But you can see the trend over time is happening. And the AI thinks Gen Z is more than twice as likely to spend on private label products as baby boomers. Baby boomers were a lot more loyal to brands, national brands. They're willing to pay 50% more for the same product because they view it as higher quality, whereas someone like me and younger are more likely not to because maybe they simply cannot afford to. So that's something to point out as well. There is a reason this is happening, and I think it's more likely to accelerate as the baby boomers, who have more of the money, way more money than the younger generations, as they pass, it will likely continue the shift, if not accelerated. And the end retailer data is king. So national brands have lagging data. They rely on incomplete sales information provided by their partners. And then on top of that, Walmart and Target have their own loyalty programs where they get end consumer data leads across categories. So AKA they know this individual at this age, at this location, buy these items together. And it can just start really shoving it and getting what we need in this store at this time for this person to just increase sales. And it does work. The AIs wrote this part pretty well. So the report accumulates an examination of retailers' ultimate strategic play, the development of a dominant private label business. Retailers are weaponizing their data advantage in a perfectly closed-loop system where national brands unknowingly fund their own competition. By analyzing the sales data of brands on their shelves, the retailers identify market gaps, engineer perfectly target private label products, and use their control over pricing, placement, and in-house retail media networks to outmaneuver their suppliers. This flywheel continuously shifts market share, and more importantly, higher profit margins from the national brands to the retailer. Because again, the retailer makes more money on the private label sales anyway. And then it goes in, and I was like, okay, define this data gap. And so I was like, okay, and retailers get to know who made their purchase, so who the demo, lifestyle, loyalty, get to know what else they bought, how they made their purchase, so they get to know like cash, credit card, promotional sales, and why they chose one product over another. And this was another good one. So the structural separation from the end consumer creates a strategic inertia for the national brands, while data native DTC brands and retailers, so DTC direct to consumer. Retailers operate on a cycle of real-time feedback. National brands are forced into a reactive posture. They rely on lagging indicators, quarterly sales reports, commission market research, and focus groups to understand market shifts. By the time a nascent trend is identified with these slow traditional channels, a more agile direct-to-consumer competitor has already launched a target product, and a data-rich retailer has already begun developing a private label alternative. And that I think is not fully understood by the market. I don't feel like the average individual knows that's happening. And it's going to continue to happen. And the data is only getting better. Like the AI is getting better. I'll start making decisions, I think, for these retailers pretty quick. You can go through a lot of data a lot quicker than I can. Like I use it on this channel all the time for a reason, because I can just gather a lot more information a lot quicker. Anyway, here another some core points on Walmart loyalty. A lot of people kind of overlook loyalty as a factor. It can be huge, right? Amex is a good example of that with Delta. You can unlock a lot of partnerships. Here, basically, Walmart Plus members spend 76% more annually. A part of that is because they have more information, so they know how to target you better. And here's Target that supposedly spent 3 times more than the average Target shopper. So loyalty is huge. And that's also a trend that will continue, or they're going to try to push. So they're going to constantly keep asking people to join their loyalty programs. Anyway, it's already kind of a long video. What can we talk about? This is just the 2025 more recent quarter, basically a continued trend of the last year. So that's one of the reasons why. So you're stagnant. You kind of guided that you weren't going to be, and then they took down guidance the prior quarter before this guy was introduced as the new CEO, Michael. And so now you have a new CEO, so because the company's been stagnant. The new CEO is kind of interesting. I actually like individuals that are hired from within. Walmart does this a lot too. So effective February 1st, 2026. So coming up here, and I also like it's the COO becoming the CEO. I always find that better than the CFO becoming the CEO, but that's just a me thing. And we'll see, maybe that opinion will change over time, but I've always found the COO's know how to run the business better than the CFOs. CFOs can report on it. They know a lot of things. But I just find the COO really understands how to make change. So anyway, we'll see if that's possible or not. He has been there his whole career. I think he started as an intern, right? But he's been in finance, merchandising, human resources, and operations. So kind of interesting time to look at it because you do have the head change at the top. And then regarding Target, tariffs is one of the reasons why Target took down their guidance, because they're seeing inflation on the line and they don't think they can pass it all to the consumers. They are mitigating the impact. They think they've done a good job positioned relative to other retailers. We'll see. Walmart has gained share in the space, right? So it's Costco. Target has ceded share over the last few years. So there's a reason why the multiples have come in for Target, right? Is viewed as the inferior business of the other two, right? And that's why Costco's at 40 times earnings and Target's at 10, right? Technically $1 earned at Costco is worth 4 times more to the market than $1 earned at Target. So, and a lot of that is negotiating with partners. So when the partners try to push price, the retailer push back and say, no, I'm not going to put that on my shelf at that price. And our position is that they'll take price as a last resort and try to offer good value at competitive pricing. And the partners are trying to navigate inflation, uncertainty around tariffs. And we've seen some people willing to push price and some people not, right? Like, do you push price but then lose share, protect your margin, or do you not push price, hopefully gain enough share that it offsets the margin decline that you're seeing? And that's a decision every of these national brands are going to make. But at the end of the day, if Target needs to fill their shelf with something and the national brand no longer wants to support that area, they could find a private label to fill that void pretty quick. And they make more money by doing that as well. So that's what I mean, is that they have the power. Here's kind of interesting. In Q1, as you might recall, 2 primary headwinds. This is when they took down guidance. That was related to inventory cost adjustments. All of that has been taken care of in the first half of the year. So that's what they said on the call. So we'll see if that's true, because we're going to find out when they report Q3. They think they're clean on the second half in terms of the inventory adjustment costs. And then about tariff costs, the majority, we had signals related to one-time costs, primarily driven by order cancellation costs. And the vast majority hit us in Q2, so you won't see a significant portions of that going forward, which implies less in Q3 and Q4. So basically they're saying we already took the inventory hit in Q1. Then we stopped buying inventory mid Q2. So basically order cancellations means we ordered something and then the supplier starts filling it, and then their target's like, no, we don't want it anymore. We're just going to pay you the penalty. So that's what happened. So that tells me they're actually on top of it. So that's something I look for when we're doing inventory turns. Like when I'm looking at a retailer, I want to make sure that I'm not still seeing the margin compression from inventory write-downs and basically promoting things that are out of fashion, out of style. For apparel retailers, in this case, slightly different, bigger, broader. But that's what I look for is, okay, are they actually dealt with as inventory overhang, right? So by canceling orders before the inventory hits their shelves, technically that's being proactive, right? It was painful because they had to report that cost in Q2, right? The share price has gone from already 100 to 88, right? So it's painful to do that, but that's what I look for in entries. Is like, did they already basically rip the Band-Aid off, or am I going to still see another Band-Aid 2 quarters from now? And that's what I'm fighting with in my head to make this a great idea versus what I think is a good idea. Here you can see the margin pressure from the higher markdown rate. So that's them basically promoting products to move it out so they can get the sale, but it hurts the margin. And purchase order cancellation costs. Now, what I would have liked them to say is how much this was in terms of this impact. I can see it's 2%, but I wanted to know this part versus higher markdown rates, right? I want to know, was this 0.5 of this? Was this 1 of this? It just helps me know what kind of cost you've decided to bear in Q2, especially when we comp that next year, right? Which should be an easy comp, hopefully. And the fun thing with retailers that really it's been an interesting time. So they over-earn 1 year, and then basically they have too much inventory, so they're discounting the next year. Then freight's through the roof still for the next year. And then they have shrink at the same time, so people are stealing more things than usual, which was putting pressure on them. And now you've never had a year yet where the retailers have like a truly normal year since before COVID. It's been it's a hard thing, I think, in this space to analyze these businesses and see what the true run rate is. I asked AI to try to figure out what the cost of canceling orders was, but it couldn't do it. Target's action to reduce excess inventory resulted in total costs of $1.3 billion in the second quarter. The largest component was from higher markdowns, meaning the company had to sell off unwanted merchandise, but it doesn't break out that actual cost that they gave to suppliers for canceling orders midway through the quarter. Here we've seen this for probably 3 years now, the trade down. So consumers are more choiceful with their spend. We've seen inflationary pressure across the household spending. We kind of talked about how discretionary categories are more impacted with their discretionary spending. The new CEO's basically saying we need to focus more on value, inclusive of price. Value isn't just price, which is good that he knows that. Here again is their slide, and this helps show what's happened. So the multiple for Target has traditionally been, I want to say, 15 times earnings or more. Certain years, more, a lot more, but around 15 times. So we're paying more for it because it was growing, and now you have stagnancy, and the P multiples come in hard. And this slide, I think, just shows that nicely. This is their original guide when they're going into 2025. This is what they thought they'd get. 8 to almost $10, not basically $9 to $10 earnings power. They've already took the guide down in Q1 to 7 to 9 after the inventory markdowns. And then they reiterated the guide in Q2 after basically incurring a lot of cancellation costs for the inventory. Allegedly, when they did that guide, they thought they have easier comparisons in Q3 and Q4 of this year, which is another reason why I'm doing the video now ahead of that. I don't know if that's still true or not, but that's what they advertised at the time of this presentation. So that's another reason why I'm looking at it now. And that's kind of what I've been thinking in terms of the valuation. You can see the analyst expectations. They don't expect a lot for this year. So a material decline in earnings growth is expected this year to finish off the year. So 7.5. And basically, they don't think Target's ever going to make what they made in terms of EPS versus the last few years. So you can see they don't even expect Target to get back to 9 till 2009, right? And they were at 9 in 2024, 9 in 2025. And these weren't great years for the company either, right? So basically they're thinking you're going to be stuck at $9 in earnings power forever. And I don't know if that's true or not. Target itself is guiding to about $15 billion right here and expected sales growth over the next 5 years. We'll see if they can hit that. That would imply an acceleration in the top line versus what they've put up over the last 3 years, for sure. But to be fair to Target, they have grown over time. So we'll have to see. The market doesn't think it will happen, obviously. But that's why we're getting the deal we're getting. And I do think the business model is superior to the national brands, which trade at a premium to what Target is currently trading at, which I hope I articulated enough today. Anyway, I'd like to know your thoughts on Target, and have a great rest of your weekend.